Hello, and thank you for coming back to watch the segment number 3 of The Curves. So, we're going to discuss your income and how that is going to affect as far as your ability to purchase. And we've talked already a little bit about credit, about the down payment, and now relative to your income. A little bit of history on this quickly is that the Frank Dodd Act, after the mortgage meltdown of 2007, has created a kind of a requirement for the income to be tested in all cases if you're going to be a residential purchaser of a property, meaning an owner occupied purchaser. And there's even requirements if you're not an owner occupied purchaser. However, the Frank Dodd Act was pretty specific to determine what the debt to ratio income is that would qualify. So, what debt to ratio income is the month to month payments that are made. Everything is broken down to a month to month basis, whether that be your credit cards, your car payments, the mortgage payment, your homeowners association payments, and that anything that is broken down again to a month to month basis. Now, likewise, the income, for example, if you're making $60,000 a year, therefore that's $5,000 a month. For example, everything is again broken down to the month, whereby they take the $5,000 per month and say the total of your debt to income ratio when you're purchasing a property. It's going to include what the new payment is, what the new taxes are, what the new insurances are, and so on. And again, everything is broken down to the monthly payment. So once you've defined that monthly payment for the purchase, meaning the loan amount, therefore you would have based upon the interest rate, but in the balance of that loan, you would determine the principal and interest monthly payment. Then you would determine how much the tax payment is divided by 12, for example, once you determine what the total tax basis is of the property. When you purchase it, that's another segment we'll talk about later regarding your taxes, as far as property taxes. But then you again define also what the insurances are. For example, if they were $1,200 a year, therefore that comes to $100 a month. And then if there were an association dues of either a condominium or maybe a PUD, for example, that requires the common areas or community services, things like that, anything that you require payment for relative to the principal and interest, taxes and insurance, and any other homeowner association dues. That's one of the factors that then determines your debt to income ratio. So say, for example, in our case, that the total monthly of the principal and interest, taxes and insurance is, say, $2,000, and your income is $5,000 per month. So that therefore becomes what they call the front end ratio. And then they look to, okay, what other credit cards, automobile payments, or anything else that may show up on your credit report effectively, or any other loans that you really have responsibility for. But basically they look at the credit report as the primary issue. And then they identify, for example, that you might have a car payment of $500 and credit card payments of, say, $500. So in which case then, you've got not only the $2,000, which is your principal and interest, taxes and insurance, and perhaps homeowners association dues. You also then add that amount to it, the $500 per month for your credit cards and the $500 a month for your automobile payment. And then the total of those, therefore, is about $3,000. Well, in a case like this where the debt to ratio income is critical, because they're looking for like 45s or pretty much the top end. There are some deals that would go up to 50s. And let's say in this case, for example, they'll go to 50. So we know that they have a 50% of the $5,000 of your gross monthly income monthly again is going to be $2,500. So in this case, for example, with the car, the credit cards, and what the new payments are on the home, that's therefore going to be $3,000, which is $500 over and above the maximum limit of, say, $2,500 in this example. So therefore, that person may not qualify for that particular property. And we've had cases where they said, gosh, I'm going to go sell that car. The $500 basically is making me in an imbalanced situation. So therefore, in order to qualify in a case like that, that's one of the things they may do, or pay off the credit cards, for example. So that back end ratio being the maximums due to the Dodd-Frank Act is something to truly look at. And then, of course, again, there's going to be other types of income. For example, W-2, you might be self-employed, you might own a corporation, you might own other buildings. There's a lot of different circumstances that require various types of requirements of tax returns and things of that nature. I'm just going to discuss, for example, a W-2 type of an employee, and they utilize the gross income in a W-2. So the gross income is really the top line. It's pretty much before taxes and everything else. How much is your gross income? And again, it goes down to the monthly amount. So if you're paid every 2 weeks, therefore, the last two, they analyze it, but it really bears down upon how long you've been on the job. That's another important aspect too, very quickly, having to do with the income, that if you have multiple different types of jobs, they have to verify each and every one of them. Or if they see you've been a person that is jumping around from one job to another job to another job, and it's just called stability, that's usually going to be a red flag for the underwriter. On the application, you must have a minimum of a 2-year window as to what your application requires, in terms of that you've been working for the last 2 years. There's some circumstances where you come out of college and you go through this kind of thing where you have less than 2 years, and there's some ways in which to deal with that. But frankly, it's a 2-year window that they're truly looking at for a standard type of an approval. So in any case, that's the segment regarding your income. And we hope you learn from one more thing from our segment, and we'll continue on, and you make it a great day. And thanks for watching The Curves.